make six figures, so you think you can afford a $500,000 home. Not so fast. The math has shifted, and lenders may approve you for more than is truly safe. Let's calculate the real survival income you need. If you want to know whether you're ready to buy or at risk of stretching too far, hit that subscribe button and turn on notifications. Let's run the numbers. Section 1. The new normal. Defining the asset. Let's be clear about what we are buying. A $500,000 house in 2026 isn't a mansion. In most major metros, it's a 3-bedroom, 2-bath starter home that likely needs updates. But the price tag is just the beginning. The problem is that most buyers rely on bank math instead of life math. Bank math, can you make the payment without defaulting? Life math, can you make the payment and still eat, save for retirement, and fix the roof when it leaks? We are going to use life math. We'll assume a purchase price of $500,000 and an interest rate of roughly 6.3 to 6.5%, which is a realistic baseline for late 2025, early 2026. Section 2. The down payment dilemma. First hurdle, the cash to close. If you follow the old school advice of 20% down, you need $100,000 in cash, plus roughly $10,000 to $15,000 in closing costs. That means you need about $115,000 available just to get the keys. Most first-time buyers don't have that. They put down 5%. 5% down, $25,000. Loan amount, $475,000. This sounds easier, but it triggers private mortgage insurance, or PMI, which is an added monthly cost for buyers who put down less than 20%. Section 3. The monthly payment, the real PITI. Let's build the actual monthly bill. It is not just the mortgage, it is PITI, principal, interest, taxes, insurance. Principal and interest on a $475,000 loan at 6.5%, this is roughly $3,000 a month. Property taxes on a $500K home assume roughly 1.2% annually. That's $500 a month. Homeowners insurance, rates are rising. Assume $150 to $200 a month. PMI, with 5% down, add $200 a month. Total monthly payment to the bank, $3,900. That's nearly $4,000 a month before utilities like electricity, water, or internet. Section 4. The phantom costs, maintenance and utilities. This is where the budget gets tight. Renters pay rent. Owners pay for everything. Utilities. Heating and cooling a whole house is more expensive than an apartment. Add $300 a month. Maintenance, the 1% rule says you should budget 1% of the home's value per year for repairs. On $500K, that's $5,000 a year, or $415 a month. You might not spend it every month, but when the HVAC dies, $8,000, or the roof leaks, $12,000, you'll be glad you saved it. Total cost of ownership, $3,900, mortgage, taxes, insurance, plus $300 utilities, plus $415 maintenance, equals $4,615 per month. We just hit a serious number, $4,600 a month just to keep a roof over your head. If this breakdown surprises you, tap like so more people see the real numbers. Section 5. The income requirement, the 28% rule. Now, who can afford a $4,615 monthly housing bill? Financial experts use the 28 by 36 rule. Your housing costs shouldn't exceed 28% of your gross pre-tax income. Let's run the algebra. $4,615 divided by 0.28 equals $16,482 per month in gross income. Multiply by 12 months equals $197,785 per year. The verdict? To comfortably afford a $500,000 house in 2026 using responsible financial standards, you need a household income of nearly $200,000. Only about 12% of American households make that much money. This means a $500K starter home is out of reach for 88% of the population, yet people keep buying them. How? Section 6. The house poor reality.
stretching to 45%. People buy these homes by stretching the rules. Banks may approve you up to a 45 or even 50% debt-to-income ratio. Let's say you make $120,000 a year, $10,000 gross a month. The bank considers $4,600 to be 46% of your income. They might say, approved. But let's look at your net pay. After taxes, 401k, and health insurance, a $120,000 earner takes home maybe $6,800 a month. If your house costs $4,615, you have $2,185 left for everything else. Car payment, $600, groceries, $800, gas, $200, student loans, $400, phone and internet, $150, you are left with $35. One unexpected expense could push you into credit card debt. This is what being house poor looks like. You live in a nice house, but you sacrifice flexibility and lifestyle. Section 7. The downside risk. Trapped. When you're house poor, you lose your most valuable asset, flexibility. If you dislike your job, you can't quit because you need that paycheck to cover the mortgage. If you get a job offer in another city, moving is difficult because selling a house costs 6 to 10% in fees. If the market dips, you might be underwater, owing more than it's worth because you only put 5% down. Buying a house at the edge of affordability isn't wealth building, it's a financial risk that limits flexibility. Section 8. The strategy. How to actually do it. If you want a $500,000 house, you have 3 options to make the math work. Increase income. You need to get that household income closer to $180,000 to $200,000. Side hustles, promotions, or a partner's income can help. Increase down payment. If you save $150,000, 30% down, your loan drops to $350,000, removing PMI and lowering the payment significantly. Relocate. Ask yourself if living in a $500,000 market is worth being financially stretched. In many parts of the Midwest or South, that same house is closer to $300,000. The math is tough, but it's better to know now than after you sign the papers. Price, $500,000. Payment, $3,900 a month, PITI. Real cost, $4,600 with maintenance. Income required, $198,000 per year to be safe. Don't let FOMO, fear of missing out, drive your biggest financial decision. Renting is not a failure, it's patience. I'm curious to hear from you. What is the median home price in your area right now? Would you rather stretch to buy now or wait until the numbers make sense for your budget? Drop your answers in the comments and subscribe for more educational content on personal finance. Thanks for watching.